Welcome to Finance Architects, how your emotions and biases affect your investment decisions. It's a curious thought, isn't it? This is where the fascinating field of behavioral finance comes into play. It's a subject that merges psychology and finance to understand why we, as investors, behave the way we do. Now, what is behavioral finance? In essence, it's a field of study that investigates how individual and group psychology influences financial decision-making processes. It challenges the traditional economic theory that humans are rational and always make decisions that maximize their self-interest. Behavioral finance, on the other hand, argues that people often act irrationally, driven by a myriad of cognitive biases. Let's delve a bit deeper. Cognitive biases are systematic errors in thinking that affect the decisions and judgments that people make. Some of these include overconfidence, where investors overestimate their abilities; loss aversion, when the fear of loss leads to poor decisions; and herd mentality, where investors follow what others are doing rather than making independent decisions. But how does this theory translate into real-world applications? Well, it can be applied in a multitude of ways to improve investment outcomes. Firstly, understanding behavioral finance can aid in the development of superior investment strategies. By identifying our biases and emotional influences, we're able to make more informed and rational decisions. This knowledge can help us avoid common pitfalls and take advantage of opportunities that others might miss. A practical application of behavioral finance is the implementation of automatic investment plans. These plans, such as dollar-cost averaging, can reduce the impact of market timing and emotional trading. This strategy involves routinely investing a fixed amount of money, thereby minimizing the influence of short-term market fluctuations on investment decisions. Another application stems from the behavioral portfolio theory. This theory advocates for the construction of portfolios that satisfy both the need for safety and the desire for potential high returns. This approach takes into account investors' psychological profiles and biases, leading to a more personalized and effective investment strategy. In summary, behavioral finance is a powerful tool that can help us become better investors. By understanding our psychological biases and emotional influences, we can make more informed decisions, develop better investment strategies, and ultimately improve our financial outcomes. Remember, the first step towards becoming a successful investor is understanding ourselves. So next time you're about to make an investment decision, take a moment to reflect. Are you acting out of logic, or are you being swayed by your emotions and biases? And that, dear friends, is the real-world power of behavioral finance.